Good afternoon, welcome to today's Premium Account ASX Top 50 Market Update for the 19th of February. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstance and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Global Equity Management Investor Signals. I've had 17 years of experience in the financial services industry as a licensed securities and derivatives advisor. The format for today's presentation, we'll look at the global macro update driving equities. We roll through the ASX Top 50. We take a closer look at some of the earnings reviews that have come through in the forward forecast, our recent transactions, and conclude with a short-term market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact me, Leon at investorsignals.com. Moving straight into a graph of the XJO now, our base case is that we saw value in the index down here, and we were buyers of the property plays, we were buyers of the BHP, Woodside Petroleum. We certainly added to the banking exposure on the pullback at these levels. We picked up the likes of Brambles, Amcor, Horizon were some of the names that we added to portfolios. We're now of the view that the index is getting back up to where we see resistance, I think at around 54 to 5,500. Is the right level to start selling covered calls. We look to cap out some of those gains over the coming months, collect that call premium and collect the upcoming dividends. The first stock that we look at in today's recording is AGK. So we're owners of it at lower levels around this 1450 level. We've sold the covered calls out into December at around the 1640 level. They're European, so we'll collect both the March dividend and the September dividend, but we see that as reasonably full value. That puts the stock on about a 4% dividend yield and on a forward earnings growth outlook of somewhere around sort of up to a maximum around 5% EPS growth for AGK. Asiano delivered their earnings result really just sort of flat or in line with expectations. We're not seeing anything there that really inspires us to look to add Asiano to the portfolio. I think at around $5.60 it's fair value. Really the upside catalyst is still whether the company comes through and upgrades its dividend payout ratio, but no news of that in the result today. Amcor earnings result came in line with expectation, roughly underlying growth around sort of 8 to 10%. On a forward outlook, we expect the company to maintain that. The issue here, as I've been chatting about, is the high PE. On a forward basis, the stock's trading about 17, 18 times earnings and on a 4% dividend yield. So I think whilst the earnings are defensive, the stock's expensive, it's likely to consolidate and move sideways. So a good one for the covered call strategy where we collect the call premium, we collect the dividend and drive around 10% cash flow out of Amcor. Not doing there in AMP. ANZ, as I mentioned earlier, we were buyers of the banks at the recent pullback when the index was at around 5,100. Our strategy here is to let the banks maybe run another 3% and then look to cap them. So in the case of ANZ at around $33 is where I start to see full value. So it's a European call option that we sell there into around that June period. So we'll collect the upcoming May dividend and also collect that call premium. But forward outlook for ANZ about 5% EPS growth. ASX was a bit of a standout result of earnings season. The market wasn't looking for much in the way of earnings per share growth, so they haven't increased their dividend, but the underlying business is growing a little bit faster than most analysts had expected. So at around $37, $38, I think probably starts to look full value over the next 6 months. We own it at lower levels. We've sold the calls up at near these levels. They're European style, so again, we collect the div, we collect the call premium, but certainly at around sort of $38.50 to $37.50 is probably the new range now for the ASX. So we continue to like that on a forward outlook across the next 2 or 3 years. I think the ASX could trade back up to sort of $40, $42. AZJ, we own this at lower levels. We've got the calls away at the 525 level and collect a good premium for those, so giving us an effective exit price up at around $5.50, but sort of hedging our bets a little here. I think at around $4.90 the stock's good value. At around $5.25 starts to get a little expensive. It's trading on a high PE on a forward outlook around 20 times earnings into next year, looking for the company to deliver around 15% earnings growth. BHP, solid result. As expected, the company's indicated that they may look to return capital to shareholders around sort of that second half of this year. But at these levels, with the stock back at 3.5% dividend yield, trading back up at about 13 times forward earnings, I think at $39 the stock's running into resistance. We've sold the covered calls at $39. We'll collect the upcoming dividend, so effectively giving us an exit price back up here to around sort of $40.50. I think that caps the upside there. But broadly speaking, I think BHP, in line with our view on the index, that it consolidates over the coming months, but eventually looking for BHP to move higher over the next 6 to 12 months. Brambles came out with a good result. I suppose the market started to get a little bit concerned that maybe they weren't going to deliver sort of their 8 to 10% earnings growth. They did that today. We were buyers of it down here at 870. Our strategy is to sell the calls up at around 925 to 950. So Brambles certainly trading in line with our expectations there. CBA's gone ex-dividend $1.83 at 5% dividend yield and around 5% forward earnings growth. I think the stock can maybe track back up towards $78 over the course of this year, but not too much beyond that. Coca-Cola came out with disappointing earnings results. Underlying business fell a further 10%, largely probably Indonesia was one of the contributors to the poor performance. I don't think that's an ongoing structural issue. I think at 5% dividend yield down here, the stock should find support. We've sold the covered calls up at around $12.45. We've collected good premium for those. We'll now be patient and wait for the stock to trade back into our range there around $12.50, and we'll look to sell calls again. Computershare, a good result within the earnings season. I think just looking a little bit expensive up here at these levels. Our strategy is to probably look for value elsewhere in the market, but certainly if we had a pullback in Computershare, we'd be happy to take another look at it. CSL, forward earnings growth of around 8 to 10%. We own the stock at lower levels. We've sold the $71 calls. I still think that the probably story for CSL is well underwritten by the company buying back 900 million of their shares and good forward earnings growth. So happy to continue to sort of own CSL at or near these levels. Crown Casino, I think this is one of the names that on a sort of 2 to 3 year outlook I think could trade probably 15 to 20% higher than where it is today. I think over the next couple of years we could see Crown trading up sort of more around $19 to $21. So the company should deliver double-digit earnings growth. But right at the moment, over the next 6 months, I think it consolidates, but ultimately can build higher prices. So we continue to take a closer look at Crown. We do own it in some of the larger portfolios. Fortescue not being there at the moment. Fox, as I'd mentioned, sort of slightly disappointed, looking for around 8 to 9% earnings growth, came in a little bit below that, but down here at around $34, $35, the stock's good value, should trend back up towards our target of around $39. Goodman Group within the property play delivered 6% earnings growth, and on a forward outlook should continue to deliver around the same. From a yield standpoint, the stock's compressing down and getting a little bit expensive. I think maybe it can trade up to sort of $4.90, but not looking for it to do too much beyond that. GPT, around 4% earnings growth, so a little bit below market expectation, but again, the company's active in their share buyback, which is helping to underpin the price. We'll look to sell covered calls around the 370 to 380 level here over GPT. IAG not being there at the moment, nor Iluka. Lendlease within the property play, we really like this. We're buyers of it at lower levels. We're looking for it to trade up towards $12. It's certainly heading in the right direction. We'll collect the upcoming 20-cent dividend. I think Lendlease will continue to grow earnings about 10% per annum over the next 2 or 3 years. Should eventually sustain a price sort of in the back half of this year up sort of more into the $12 to $13 range. But certainly over the next 6 months as a result of this earnings season, I think around $11.50 to $12 the stock runs into resistance. NAB, as with ANZ and Westpac, we're buyers of it at lower levels here. As it gets up to these levels, I think it's starting to get a little bit expensive. We look to sell the covered calls up at around $36.50, collect the upcoming div into May. Newcrest, slightly better earnings result, as I've spoken about, than maybe the market was expecting. Good production numbers, slight improvement in gold prices. We need gold to push from the current levels up to $1,400 US an ounce for it to really kick on and sort of trade back up to around that $15 level. Origin, not looking for much in the way of earnings growth here out of Origin, with the stock trading on a very high PE. I'm not looking for. So on a forward outlook, the stock's trading at about 19 times earnings on a 3% dividend yield. So as I'd mentioned, around $15 is where we see resistance. So we're happy to sell covered calls at or near this level, collect the upcoming dividend. I really think Origin's a story for next year where the stock could trade sort of much higher into the middle part of 2015. Oil search, the oil and gas plays are continuing to do well. I'd highlighted that this is an area of the market that we're looking to allocate capital to. Santos and BHP have been our preference, but certainly oil search should continue to do well from these levels as well. Good production numbers in the case of Origin and in the case of oil search. QBE not doing there at the moment. Rio, again, our preference has been BHP over Rio. Stockland's delivered earnings that slightly exceeded market expectation. On a forward outlook, the company should deliver about 6 to 8% earnings growth. From a dividend yield standpoint, the company reaffirmed its upcoming 12-cent dividend. It is worth noting, though, that the company's paying out close to 100% of its earnings in dividends, so there's not a lot of headroom there for them to increase dividends beyond sort of the earnings growth of the business. But I think the stock can support $4. We're happy to cap that out at around the $4.20 range. Sonic came in line with expectations. Santos, so this is one of those names that we've added to on the recent pullback at $13.50. We're selling the calls at around $14.50. We're getting good premium for those, effectively giving us an exit price up here to around $14.75. Looking for the stock to now move sideways. Transurban, so we've added to this position at around this 675 level, looking for the stock to trade up to around $7. It goes ex-dividend a little bit out of sync to the rest of the market, so not until May. So I think maybe we're probably at $7 the stock starts to consolidate. As we get into April, May, I'd expect it to start to push up a little bit closer to $7.25, but we're happy to cap the upside. Can't see the stock trading anything below a 4% dividend yield, so limited price expansion above $7.25. Telstra delivered a good earnings result. We expected it to trade up towards this $5.25 level coming into the div. They've increased the div from 14 cents to 14.5. I think at around $5.25 is probably where it should sit. Strip out the 14-cent dividend and the stock pulls back to around $5.10. I think it'll consolidate after the div. Maybe it can trade back up to sort of $5.25, $5.50 into the back half of the year, but certainly wouldn't expect it to be any stronger than that. Toll came out with a slightly disappointing earnings result. We were not expecting too much in the way of earnings growth, but the company missed on even sort of that flat forecast. We own it here at around $5.50. We've sold the $6 calls. As those wind off, we'll now look to shift the next round of covered calls down to around $5.75 at a 5% dividend yield and limited earnings growth. I really think sort of that at best Toll trades sideways from here. Westpac, so good fundamentals here driving the banks. Bad and doubtful debts are falling, loan growth's picking up, and the property market's continuing to strengthen and business confidence is improving. In the case of Westpac, I think sort of around sort of $34 into probably June in a European option where we capture that call premium and we capture the upcoming dividend is sort of the way we see Westpac with a forward earnings growth of around 5%. WDC at $10 with the view that it was good value. I think it'll trade back up towards $11. At that point, the dividend's compressing down to around 4.5%. We've got a bit of obviously a restructure that's got to come through in the course of the coming months where WDC is going to spin off certain assets and merge them with WRT. It has to go to shareholder approval. We probably really need to see the dust settle on that to really get a firm view if there's a change of earnings outlook. Our initial analysis says is that really it doesn't in the short term change the value substantially for WDC or WRT. So it's really the assumption that earnings grow at around 3 to 5% for WDC, and in which case it could support a price of around $11, but nothing too much beyond that. Wesfarmers, Wes and Wool's really growing at around sort of that. Probably Wesfarmers slightly quicker than Woolworths, but on a 4.5% dividend yield and trading about 18, 19 times next year earnings, the stock's certainly getting expensive. And we conclude today's recording with a quick look at Woolworths for the final stock here. We own it at lower levels and we're capping out the gains at or near these levels. Thank you for listening in.